In a world where fortunes are made and lost with the click of a button, the secrets to building lasting wealth might just be found scribbled in the margins of your kindergarten class notes. That's right, the same place you learned the virtues of sharing and the dangers of eating glue might hold the keys to financial success. Legendary investors, the titans of Wall Street, have consistently leveraged 4 fundamental principles that might seem as elementary as "don't eat the yellow snow," but mastering them is anything but child's play. Number 1. Objective indicators. Imagine you're in a room with a high-priced lawyer, a low-priced lawyer, and the tooth fairy, and there's a $100 bill on the table. Lights go out, lights come back on, the $100 bill is gone. Who took it? The high-priced lawyer, of course, because the other two are just figments of your imagination. This riddle underlines the essence of using objective indicators in investing, distinguishing reality from fantasy. Objective indicators are the compass of the investing world. They don't flirt with emotions or get swayed by the gossips of the market. These are cold, hard numbers, think inflation rates or bond yields, that guide investors on when to buy or sell. For instance, historical data shows that when inflation dips significantly below its 5-year average, markets have tended to shoot upwards. These indicators are not just numbers plucked from the air, but are backed by rigorous mathematical analysis and historical performance. They help investors avoid the common pitfall of relying on gut feelings, which can often lead to disastrous financial decisions. Number 2. Discipline. Investing, much like a classical Greek tragedy, can unfold with dramatic twists and devastating downfalls, often driven by a protagonist's fatal flaw. In the financial world, this flaw is typically the lack of discipline. Investing without discipline is like trying to swim against the tide. You might put in a lot of effort, but you're not going to get very far. Discipline in investing means sticking to a well-thought-out plan despite the emotional roller coaster of the stock market. It's about setting and following rules that help mitigate investment risks. This could mean deciding in advance how much loss you are willing to tolerate, or at what profit point you will sell an asset. Legendary investors have likened discipline in investing to training for the Olympics. It requires commitment, patience, and a strict adherence to one's training regimen, ignoring the distractions. Remember, in the market, chaos isn't your friend. Discipline is. Flexibility in investing doesn't mean you change your strategy with every market fluctuation. Rather, it's about adapting to significant changes without abandoning overall discipline. It's the art of pivoting gracefully when facts change, while keeping your investment philosophy intact. Consider the story of an investor during the 1980 stock market dip who remained bearish despite market recovery signals like falling interest rates and easing credit controls. His flexibility to shift gears and adapt to the new market environment allowed him to recover and even profit, whereas rigidity could have resulted in significant losses. Flexibility is about being prepared to switch tracks if there's a boulder on the path you're on, not changing directions with every wind gust. As the market evolves, so should your strategies, albeit thoughtfully. If you don't risk anything, you risk even more, goes the saying. But in investing, how you manage that risk determines your long-term success. Risk management is about knowing how to protect your assets and making decisions that maximize gains while minimizing potential losses. This involves setting clear boundaries on how much you're willing to lose on a particular investment and sticking to it religiously. It's about not letting a bad day turn into a ruinous one by making emotion-driven decisions. The best investors don't just look for opportunities to profit. They also constantly assess what could go wrong and how they can shield their portfolios from those scenarios. This proactive approach to risk management is what separates seasoned investors from the novices. Investing might seem like a complex game reserved for the Wall Street elite, but the principles that guide successful investors are remarkably simple. Use objective indicators to make informed decisions, exercise discipline to stay the course, remain flexible to adapt to changes, and manage risks to protect your assets. These aren't just strategies, they are the pillars upon which wealth is built and preserved. Whether you're a budding investor or looking to improve your financial strategy, embracing these timeless secrets could not only safeguard your investments but also multiply them. Remember, the path to unlocking wealth requires more than just financial capital. It demands intellectual and emotional investment in these fundamental principles. So, gear up, use these strategies, and watch your investments grow, not just in your kindergarten class notes, but in the real world of investing. Thank you for reading this essay on Unlocking Wealth: The 4 Timeless Investment Secrets. If you found these insights valuable, don't forget to like, subscribe, and follow for more content like this. Your engagement helps us to keep delivering quality insights directly to you. Remember, investing is not just about money, it's about making wise choices with the resources you have. Until next time, keep investing smart and let the principles of objective indicators, discipline, flexibility, and risk management guide you to financial success. Happy investing!